Hey, what's up guys, it's Jonathan here, back with another public stock portfolio update. So as usual, do a quick recap of some of the moves that we made in the portfolio this week. Then we'll do a recap on how the portfolio is doing overall. Then we'll talk about what happened this past week in the markets. So with all of that said, let's get right into it. So for this week, we deposited our $10 as usual, but we didn't make any buy or sell moves in the portfolio. As I've stated in other portfolio update videos, my plan is to kind of wait this market out a little bit until we start to see more positive news in the market and that move up is a little bit more permanent. So now let's go into portfolio and see how the portfolio is doing overall. So currently the portfolio is worth $184.10 and all time it's down about 24%, and for the past week it's down about 4%. So we still are depositing the $10 a week, so we have about $31 worth of cash in this account ready to buy anytime we see a good deal come up. So first position we have here is Tesla. Our Tesla position is down about 2.5%. I think this is the first time I've ever seen our Tesla position in the red. Tesla has been one of the stocks that have actually held up throughout all this stock market madness we've seen over the past couple of months. So it's a little surprising to start seeing Tesla start to fall as well. Usually in a broad market downturn, the big companies are the last ones to usually start falling. So it could be a sign that we may be at the end of this sell-off, but we'll have to see. Next position we have here is Enphase. Our Enphase position is down almost 15%. I believe Enphase right now is about $140 a share. Generally in the past, I've always seen $140 for Enphase to be a steal. But as we start to see more of this valuation compression throughout the entire market, especially when it comes to more higher multiple stocks, sort of like our technology stocks, our growth stocks, my buy numbers are starting to go down as well. So Enphase at 140, in 5 years from now, it probably won't matter if you did buy Enphase at 140. It probably won't even matter if you bought Enphase at 200. So next position we have here is Robinhood. Robinhood was one of the first companies to take the beating throughout this downturn, and it hasn't really let up too much. I do believe Robinhood is either at all-time lows right now or it's pretty close to all-time lows. So we'll see if it falls anymore, but really this stock shouldn't be down this much as it is right now. Next position we have here is Google. Our Google position is now down almost 9%. And like I said with Tesla, we are starting to see some of the mega caps fall as well. So that is something, again, that could signal the end of a sell-off, but we'll have to see if this is actually the end or not. So next position we have here is Etsy. Our Etsy position is down almost 33%. This whole portfolio right now is really taking a beating. I mean, it is mostly growth focused, so it makes sense why it would be taking a beating, especially when valuations are compressing. So like what I was saying about Enphase, you could apply the same thing to Etsy as well. We are starting to see more valuation compression, so some of these stock prices are going to go down naturally with that as well. I don't think buying Etsy at the price that it is today is necessarily going to be a bad deal if you look at Etsy as like a 5-10 year play. So next position we have here is Nvidia. Nvidia position is down 11%. We'll go a little bit more into detail in Nvidia, but they did report earnings this past week and it did beat on expectations. So good news from Nvidia. But still, like I said, the valuation compression is really hitting these growth stocks hard. Even growth stocks that are very profitable like Nvidia. So next position we have here is Amazon. Our Amazon position is down 11%. And when it comes to Amazon, I think they're really going to struggle until we start to see the price for shipping start to cool off. And we see some of those supply chain issues start to return back to normal. But until then, I think that Amazon will be a stock that will suffer for quite a while. So if you are bullish on Amazon, it may be a great time to pick up shares, but we'll have to just see where things go from here in terms of shipping costs and supply chains. Next position we have here is Cloudflare. Our Cloudflare position is currently down almost 22%. When I talked about valuation compressions with Etsy and Enphase, this also does apply to software companies like Cloudflare, but usually these companies end up getting compressed even more just because they have such crazy high valuations. And because of that, we can see a lot of compression in their stock prices as well. So I believe Cloudflare did report this week or week before that, and they actually had pretty good numbers and pretty good guidance. But it was just that valuation compression that the entire market has been dealing with is really starting to catch up with Cloudflare right now. Next position we have is Trade Desk. So Trade Desk did report earnings on Wednesday. So they missed on their EPS estimate, but they beat on revenue. But unfortunately, that beat on revenue wasn't enough to stop the stock from falling 12% after earnings were released. And I think that this was mostly due to just the overall compression we're starting to see in the advertising market. I think Facebook's guidance was a really good indication of where the ad market is going. You know, Facebook talked about how they're going to probably miss estimates by almost 50%, just because of the fact that because of the supply chain issues, a lot of companies are having a hard time getting product. And because they don't have product, they don't really have the necessity to advertise their products. So the advertising space may take some beating until we do get some relief of the supply chain issues. So on Trade Desk, we're currently down about 7%. The next position we have here is Matterport. Matterport reported earnings as well on Wednesday after hours. And like Trade Desk, they did miss on EPS, but they did beat on revenue. But even though they did beat on revenue, their stock still fell 13%. This was mostly due to the lackluster guidance they gave. Matterport is in a little bit of a pickle because it is in a position where it's trying to switch out its revenue source from mostly hardware stuff, like the 360 cameras they sell and stuff like that. And they're trying to switch more to the service software side. And this is mostly because a lot of iPhones could do a lot of these Matterport scans. So there isn't really a need for people to buy the camera, but they do need to buy the software to be able to process those photos. Matterport is going to go through some pain while they're doing this transition. So that is something to keep in mind if you are invested in Matterport. Next position we have here is Sofi. I believe we have to wait a little bit before we get Sofi earnings, but currently we're down about 18% on Sofi. I think Sofi is getting caught up in the same web that Robinhood's getting caught up in, and also Square as well. Just the fintech space right now, like I said, the valuations in these spaces are pretty high already. So you get valuation compression, the stock price is getting compressed as well. Next position we have here is Palantir. Our Palantir position is currently down 51%. Palantir at $25 was a very expensive price to pay for this company. Palantir is a software company, kind of like Cloudflare, so it's very high valuations on these companies. And again, that valuation compression is really coming true. Also with Palantir as well, they did report earnings on Thursday after hours, and they missed on EPS, but they did beat on revenue, which is sort of the same thing that happened to Trade Desk and Matterport. And Palantir did fall 15%, and for me, I think it was mostly, again, that valuation compression and their miss on EPS. So the next position we have here is Redfin. Redfin also reported as well. And for those of you who were at the Redfin earnings call video, first thing, thank you guys for showing up to that. That was really good to hear from this company's executives about what's going on with Redfin. When they did report, they did beat on EPS and they beat on revenue as well. But even with those beats, the stock still fell 18% off of this news. And I think that this was mostly due to A, the guidance, and B, also the fear that the housing market will start to cool off as interest rates start to rise. We did have some pretty important earnings calls this week, in my opinion. Important ones, at least for me, was NVIDIA, since I am invested in NVIDIA. In the earnings call, they talked about how, like most of the other tech hardware companies, they are suffering from supply chain constraints on semiconductors and other pieces they need for their hardware products. But they are looking to expand their supply base, and they're expecting the supply issue to get better over the rest of the year. They're also asked about if these supply chain problems are putting a cap to the business that they can do. And they did state, yes, that this is the case, that they would be able to do much more in business if there wasn't these supply chain issues. And if you ask any person who's in the market for a GPU right now, they'll tell you that NVIDIA GPUs are almost impossible to find. So I think that NVIDIA, once these supply chain issues clear up, they can start to do better. It is good to know that they do have a pretty substantial software side of their business as well. And that side of their business is suffering from valuation compression. So we may still see some pain in this company even as supply chains start to clear up. But their company is definitely more of a hardware company than it is a software company. So it's something good to keep in mind. We also heard from Walmart during their earnings call. They stated that they have wider price gaps in comparison to the pre-pandemic times. And pretty much what price gaps are is the difference between Walmart's price and their competitor's price. So, for example, it'll be a difference between like Walmart and Amazon's price, or Walmart and Target's price, or something like that. This is a sign that they aren't raising prices very much, and any increased costs, either them or the merchandisers are taking on that cost. And when they're asked to go into more detail about this, they talked about how they even plan to discount more items at their stores. So this could be happening, because either merchandisers or Walmart themselves are taking the loss on the inflation on these items, or this could also be from the fact that Walmart did stock up on an array of different products during the fall of 2021. For those of you who are involved in the news cycle, you probably did hear about this, how a lot of big box retailers were starting to prepare for the holiday season back in the fall of 2021. They may still be running off of this built up inventory that they have. They didn't really specify why they had so much inventory and why they're able to deal with a lot of these inflationary pressures. So Walmart also discussed that they did have increased costs in Q4 of 2021, mostly due to wages and supply chain issues. So when it comes to wages, they talked about how there was a lot of employees who were taking COVID leave, and this COVID leave did increase their expenses. But they also talked about how them taking on some of the costs of the inflation that we are seeing, that is playing a role as well. The supply chain issues are a little bit better for US manufacturers than they are for foreign manufacturers. So something else to keep in mind there. They also did notice an uptick in their market share of the retail space. And to them, and also the market overall, it does show that people are more price sensitive. Because think about it, if you're price sensitive, where are you going to shop? Walmart or Target? Most likely you're going to shop at Walmart, because you could get a better deal on whatever you're buying at Walmart than you can at Target. That is a sign that the consumer is starting to become more price sensitive. So something else to keep in mind. When the executives at Walmart were asked by one of the analysts, what is the company's biggest risk in 2022? They stated that their biggest risk is inflation, mostly inflation of wages and inflations of goods. So even though right now Walmart is taking on some of these price increases, we may start to see them shift away from this if inflation does become more persistent over time. At least that's my thinking behind that. So in my opinion, the way I see Walmart is that they're almost like Apple. They have a lot of pricing power in the market when it comes to suppliers, and they also have a lot of leverage to be able to get the things that they need. So I think that's some of the reason why we are seeing some of this strength from Walmart. But it is something for us to see if in future quarters this is the case, especially if inflation does start to become more persistent. Another important earnings call this week was Marriott. Marriott talked about how they're struggling with wage inflation. And I actually recently just stayed at Marriott. So typically when you go to a hotel, they usually will clean up your room every night, right? Marriott, what I've noticed they started doing is that they actually only clean your rooms every 4 nights. And in that case, the only thing they'll do is just replace like towels and bed sheets. For a full cleaning of your room, you have to wait 7 days. So if you're only in town for like a day or two, they won't even clean your room. This has been one of the things that they have done to try to combat some of the wage inflation that we are seeing. They also did say that they have been charging higher rates than normal, but they have noticed that customers are willing to pay for it. Again, that's another big sign of inflation, because companies will continue to raise prices as long as consumers are willing to pay for it. Until consumers are not willing to pay these inflated prices, the prices will continue to move up. Then also when we talk about inflation, we ought to talk about the situation that's going on in Russia. So last Monday, I believe there was word from the Russian government that the Russian military forces were starting to pull back from the Ukrainian border. Later that same day, NATO and the White House stated that there was no evidence of this. They actually believed that there was more troops sent to the Russian-Ukrainian border. And then again, on Friday, the White House said that they believed that Russia would move in on Ukraine the next couple of days. And there was some belief that Russia was waiting for the Olympics to be over, mostly because the leader of Russia, Vladimir Putin, and the leader of China, Xi Jinping, I think that's how you pronounce it. I'm sorry, I don't know. I don't really know offhand. They're both friends, and Putin didn't want to go and attack Ukraine and take the eyes off of the Olympics that's currently going. The Olympics that ended just this past Saturday. So a lot of people were looking to the 20th to the 21st as being a big day, that if Russia was to make a move into Ukraine, that's when it would happen. Now, on Sunday, we got news that the French president, Emmanuel Macron, is open to having a discussion between US and Russian leaders about a diplomatic plan to avoid an invasion of Ukraine. And if you watched last week's market update video, I did state that if Russia was to invade Ukraine, that would move markets dramatically, as it will leave supply chains even worse off than they are right now. And also, it would cut off Russian oil from the rest of the world, essentially, or from majority of the rest of the world, causing oil prices to skyrocket. Given that fact that oil is basically used in almost every supply chain, skyrocketing oil prices does have the possibility of triggering a recession. So the hope is that we can resolve this conflict peacefully. It doesn't turn out into an invasion or a war or anything like that. Because obviously, for the economy, it wouldn't good. For the standard of living of the Ukrainian people, it will not be good either. So the hope is we can get it resolved. So also this past week, the producer price index did come out. And pretty much what the producer price index is that it's the amount that producers are paying suppliers for the goods that they need to produce items that they could sell to consumers. So almost think about it like the CPI, but it's for producers instead of consumers. The number came in at a 1% increase month over month, or a 9.7% year over year increase, which is almost double of the month-to-month expectation of 0.5% that we were expecting. And it was led by energy, which was up 2.5% month over month, and food that was up 1.6% month over month. This shows that producers are getting shafted just as bad, if not worse, than consumers themselves. So that's basically all I got for you guys this week. Thank you guys so much for watching. If you enjoyed this video, please hit the like button down below. It'll greatly help out the channel, help push this video out to as many people as possible. Also, if you enjoyed my videos and you enjoyed the perspective I bring, please consider hitting the subscribe button for the YouTube algorithm. Also, let me know what you guys think about the markets. And also, let me know if you guys want me to add anything to these weekly portfolio updates in the comment section down below. I would love to hear from you guys. Check me out on all my social medias to try to post there as often as possible. And thank you so much for watching. I'll see you in the next video.